Well, you do, and I think you'll see the big move in the impeachment was kind of the disappearance of Joe Biden, and I do think there are certain stocks, especially like financials and healthcare, that will live under an umbrella of fear as long as Elizabeth Warren is a possible president. So I think she would have a pretty dramatic effect on the markets, but definitely certain segments. And in terms of the impeachment, I think most people right now are pricing in impeachment but not conviction, and that's just a lot of noise. It doesn't actually directly impact the market.
Grant, how do you factor all of this political kerfuffle on impeachment and the Democratic candidates and so forth into your investing matrix?
Not to say that we don't care about it, but it's not as important in terms of the determinants of fundamentals for the companies that we invest in. If you recall back in 2015, 2016, before President Trump was President Trump, there was a lot of concern that President Trump would lead to a negative environment for equities, and that turned out to be absolutely wrong if you looked at the first couple of years of the presidency. So yes, if you look at the extreme side of the Democrats, there would certainly have impacts on areas of healthcare and banks in general. I would say that it's a little bit too early to tell what the impacts would be on a longer-term basis, fundamentally for the companies that we look at.
So use the last election and its history as a guide, not to jump to conclusions.
And I think when you look at politics, a lot of people take their own personal opinions into play, which may be hard to separate from the fundamentals at hand.
Mm-hmm.
Tom, what's your outlook for the fourth quarter? I mean, here we are, the first trading day of the quarter, and we're down more than 1% pretty much across the board at session lows right now. Weak manufacturing data here as well as abroad. So what are you anticipating? And does it feel to you at all like fourth quarter of last year where we saw that severe drawdown?
Well, I think it's a little early to classify it similar to last quarter, last year. That was pretty dramatic. And even the volatility we saw in the third quarter, you're kind of waiting for it to end, but be careful what you wish for. I think right now, when I talk about the fear in the marketplace, it's pretty great. And I think the ISM number now, today being weak, is pretty dramatic. But I think if you dive into the numbers and you see where the weakness was derived from, it's from exports. Exports are down. And when you think about it, that makes sense. When you're getting a trade war, exports go down because there's uncertainty and things kind of slow down. So we need to get through that before I think you see the animal spirits return to the marketplace.
I mean, the setup, though, Grant, going into we have tech companies lowering their guidance going into earnings season. We've got the highest number, 29 firms cutting, since FactSet started tracking this data back in June of 2006. I mean, that's a pretty dramatic number for the biggest sector in the S&P 500. We've already got some pretty disappointing earnings from Micron, Carnival, FedEx, and we have data that looks like it's softening at this point. Are you worried here going to the last quarter of the year?
So we're always worrying, right? That's our job.
Are you more worried?
But I would say what we're trying to ascertain the difference between is structural demand and cyclical demand. After 10 years of a rising tide lifting all boats, you're at a point in time where there are cyclical companies, so you mentioned FedEx, that have masqueraded as structural growth companies. And so what we're trying to do for our clients and our portfolios is ensure that, not to say that our portfolios are recession-proof, because that's not possible, but that we're investing in companies that are more resilient during times of uncertainty. And we expect uncertainty to be the name of the game as we move forward in the fourth quarter and into 2020.